Money can be a funny thing. It's something we all use, something we all need, and yet it's something that many of us don't fully understand. We use it every day, in countless transactions, from buying a cup of coffee to paying our rent or mortgage. It's so ingrained in our daily lives that we often take it for granted. But have you ever stopped to think about what it really is? What gives that piece of paper or those digital numbers in your bank account any value at all? See, dollars aren't really tangible assets. They're more like promises. Promises made by the government that these pieces of paper or digital entries can be exchanged for goods and services. It's a system built on trust and mutual agreement. Promises that you can trade for almost anything you need or want. Food, gas, a new phone. But these promises are only as good as the trust people have in them. Commodities, on the other hand, are different. Gold, silver, oil. These are tangible, real assets. They have intrinsic value because they are physical items that can be used in various ways. Their value might go up and down, but they're always there, always tangible. Their value might fluctuate with market conditions, but they remain valuable because they are finite resources with practical uses. Now, here's the kicker. When the dollar gets weaker, meaning those promises aren't worth as much, it can have a ripple effect on the economy. This can happen due to inflation, economic instability, or other factors. Commodities like silver often get stronger in such times. People turn to these tangible assets as a safe haven, a store of value that isn't as susceptible to the same risks as paper money. It's like a seesaw. One side goes down, the other goes up. When trust in paper money falters, trust in tangible assets like silver and gold often rises. This dynamic balance is a fundamental aspect of our financial system. So, why does the dollar weaken? Lots of reasons. It's a complex issue, influenced by various factors that interact in intricate ways. One big one is inflation. Inflation is when the prices of goods and services rise over time. When prices go up, your dollar buys less. This means that the purchasing power of your money decreases. It's like your money is slowly shrinking. Imagine going to the store and realizing that the same amount of money buys fewer items than before. Another reason is government debt. When the government borrows a lot of money, it can affect the value of the currency. When countries borrow a lot of money, it can make their currency less valuable. This is because high levels of debt can lead to concerns about the country's ability to repay. Think of it like borrowing from your credit card. When you borrow money, you have to pay it back with interest. A little debt might not be a big deal. If you manage it well, it can even help you build credit. But if you keep borrowing and borrowing, lenders might start to worry about whether you can pay them back. This can lead to higher interest rates and more difficulty in borrowing in the future. Another factor is international trade. When a country imports more than it exports, it can lead to a trade deficit. A trade deficit means that more money is leaving the country to buy foreign goods than is coming in from selling domestic goods. This can put downward pressure on the value of the dollar. Exchange rates are influenced by the balance of trade, and the deficit can weaken the currency. Central bank policies also play a role. When the central bank lowers interest rates, it can make the currency less attractive to investors. Lower interest rates mean lower returns on investments denominated in that currency, leading to a decrease in demand and value. Global economic conditions can also impact the dollar. Economic instability in other countries can lead to fluctuations in the value of the dollar. During times of global financial crisis, investors might seek safer investments, which can either strengthen or weaken the dollar depending on the circumstances. Understanding these factors can help you make better financial decisions. It's important to stay informed and consider how these elements might affect your personal finances. By keeping an eye on inflation, government debt, trade balances, and central bank policies, you can better navigate the complexities of the economy and protect your financial well-being. Silver has been a store of value for centuries. From ancient civilizations to modern economies, silver has played a crucial role in trade and wealth preservation. Its luster and durability have made it a symbol of stability and trust. People turn to it during uncertain times. Why? Because it's tangible. Unlike digital currencies or stocks, silver is something you can physically hold and see. It provides a sense of security that is unmatched by other forms of investment. You can hold it in your hand. This physical presence gives it an intrinsic value that is not dependent on any institution or government. It's a universal asset, recognized and valued across the globe. It's not a promise written on a piece of paper. Unlike fiat currencies, which can be devalued or rendered worthless by economic policies, silver retains its value. It doesn't rely on the stability of a government or the performance of a company. When people lose faith in paper money, they often turn to hard assets like gold and silver. These metals have historically been safe havens during financial crises, providing a hedge against inflation and currency devaluation. It's a way to protect their wealth. By investing in silver, individuals can safeguard their savings from economic turmoil, whether it's through coins, bars, or other forms. Silver offers a reliable means of preserving and growing one's financial security. History is full of examples of silver holding its value when currencies falter. Look back at the 1970s. Big inflation, lots of uncertainty. The price of silver shot up. More recently, during the 2008 financial crisis, people got scared. They wanted something safe. Guess what? Silver went up again. Now, I'm not saying silver is the only answer, but it's something to think about, especially when the dollar is shaky. Remember, diversification is key. Don't put all your eggs in one basket. Stocks, bonds, real estate, these are all important too. But having some silver in your portfolio can act like an insurance policy against inflation and economic turmoil. In uncertain times, people crave stability. They want something real, something they can hold on to. That's the appeal of tangible assets. They have intrinsic value. They're not just numbers on a screen. Think about it. A house, a piece of land, a rare coin. These things have worth beyond just the price tag. We live in interesting times. Lots of debt. Inflation is still a concern, and the world seems a bit crazy. This is when it's more important than ever to protect yourself. Silver isn't a get-rich-quick scheme. It's a long-term strategy for preserving your wealth. If you're thinking about buying silver, do your homework. Learn about the different forms of silver: coins, bars, bullion. Find a reputable dealer. And don't invest more than you can afford to lose. Remember, knowledge is power. The more you know, the smarter decisions you can make. The world of money can be confusing, but one thing is for sure: you need to protect yourself. Don't rely on anyone else to do it for you. Take control of your financial future. Silver is just one tool in your toolbox, but it's a powerful tool to have when the dollar goes down.